Alrighty, traders. This is Blake Morrow. You are listening to the Morning Edge webinar, and we are getting started. So, what should I say? Well, let's start off here. Cable moving higher, and this is a double bottom breakout as long as we stay above 139.20. Frankly, I didn't think we were going to make this move. I was skeptical. Let's just put it that way. As the dollar looked like we were, finding some support at different areas, and I just didn't think the cable was going to do it, but it has. And the euro's made a nice run, but you have to be a little careful because I'm worried that stocks are going to turn lower today. If you guys don't know why I think stocks are at risk right now, let me show you. If you are not in the chat room, this is, you didn't get this then? Okay, so here's your DSI. Volatility dropped below 10. And the thing is, and Greg posted this on Friday, which is really good information. Here, let me get rid of that for a second. He took it right from the DSI website. Was the longer the extremes, the longer we stay in extremes, the more aggressive the reversal is going to be. And one of the things that I have to point out here is volatility. If you look at, this is Friday, this 10 was Thursday, 13 was Wednesday, wait, no, I'm sorry. Yeah, 13 was Wednesday, 10 was Tuesday, 10 was Monday. You're seeing these extreme numbers for a long period of time. And when that happens, the reversals tend to be pretty aggressive. I also want to point out that when I've seen them just peak their head to 10 and then you reverse back to 20, it's just like kind of a pullback, or it's just you get just a quick correction. We're seeing a very persistent move in sentiment, whether you're talking about stocks or whatever. So that is getting very extreme. And so I'm worried that we're going to see stocks reverse. And this is like a last move before we see, a last move lower in the dollar before we see an explosive move the other direction. And that's what I'm worried about. And that's why if you're long the cable right now, or the euro or anything else, just mind your stops. Don't let any trade get away from you too long, because if we get some reversal in equities because of these extreme sentiment readings, the dollar that you've seen right now, this could be that I just shook everybody out before we make a big move, right? And so let's note a couple of areas for the cable. So first and foremost, 139. That it's 139.10, or I'm sorry, 15. You want to give it a little bit past that. I'm going to say 139 support. Resistance, 139.89, which is the 127% extension. Let's give it a little bit past that towards 140. So 139 and 140. And while we're above 139, we have to be bullish because it's a double bottom. But I will not be shy about flipping that back around, if we close the day back below 139. Because you guys know my stance here. I'm telling you my stance. My stance is I'm afraid this is a false breakdown in the dollar today, because I think stocks are going to move lower and the dollar is going to catch a bid, right? But that's like, okay, look, same with the euro dollar. We just squeezed all the shorts out, And if we get back below 119.90, now I'm not putting this one in bullish. I'm just not, because there's no double bottom here. This is just this is probably a, you know, as long as we're below this trend line, I'd have to keep it in range. But the next resistance comes in at 121. Okay. Aussie dollar. Aussie. Oh man, I'm really, really, really tempted to be short up here. You guys know that the 78.10 level, big to me. Keeping it in range. Support right now, I would give it below these lows at 77 cents. I give it down to this support here at 76.80. So support being right here, or 76.75. Let's write that down. Oops. That's not what I wanted. Okay. Kiwi. Here's a Kiwi. Barry said yields. Yeah, we'll look at yields actually. And I mean, you got to pay attention to like what's happening with the yen and all these yen pairs too. That's another big, you know, possible move here. All right. Here's the Kiwi. So the Kiwi almost up to the 50% retracement. I think 72 cents is what we wrote down as resistance on Friday. Yeah, 72 cents. Support, 71 cents. Same. All right. Dollar Canadian. So the dollar Canadian, once again, holding support here at the 127% extension. That 127% extension, I mean, you can see how we tested that low. Relative strength is divergent. So resistance is at 126. Let me get rid of this. 126, support 124.70. Remember the Bank of Canada this week. And remember that I'm going to say what I say. I'm going to say what I said on the week ahead video, and I'm going to about the Bank of Canada this weekend. So economic data for Canada has been good. The COVID situation in Canada, not so good. And the Bank of Canada tends to be very much they tend to follow the FOMC's lead. And you know, those two central banks, they talk because we are Canada's largest trading partner. They want to stay in line with what we're doing. We have a lot of cross-pollination between the two countries. And so there's, you know, obviously a lot of synergies with Canada and with the US. And that goes with a lot of different things, including monetary policy. So I think the market is expecting the Bank of Canada to continue to stay relatively neutral just because their economic data has been pretty good. But if they start to err on the dovish side and mimic more of what the FOMC has been, you know, the messaging we've been getting there, the problem is the US dollar Canadian can end up, well, back above 126 again. So I would be really careful about the dollar Canadian down here. Okay. I think we could very easily be right back up here by the end of the week, if not higher. Okay. So just little heads up. Okay. And you know, it's interesting. And I was telling everybody in the on the week ahead video, you know, Raj is in our chat room and other Canadians too. But I was talking about how, you know, the Canadian economy, the economic data may look strong, but you know, we have people that live in Canada that boots on the ground in our chat rooms that are like, it's really not as strong as you would think. And so that's just, yeah, it's important to keep your eyes and ears open and be careful. Technically, we're just near support on the Canadian. Now the Swissy. So the Swissy broke. We finally broke the 91.90, took us down the 127% extension. We cannot rule out a move at this point down to here. Okay. Because this was the inverted head and shoulder pattern completion. You can see we you know, once we completed it, we stalled. I know it's not a fib level per se, but that's going to be in the next support. Roughly about 90.85. And while we're below 92 cents, I think we have to flip it to bearish right now. Well, nah, you know what? I'm not even going to do that. I'm just going to keep it in range, because we're still above like some multi-month trend line breaks and stuff. And here's the 200-day moving average, still comes in down here. So I don't want to get too, you know, I don't want to flip it to bearish necessarily. US dollar, Norwegian krona. Now this is a big breakdown. And I'm bummed out because I got stopped out, but I look at it and I still think, man, this could be a Wyckoff because you know, if we end up getting a false breakdown like we did here. But while we're below at this point in time, while we're below 835, we have to stay bearish. We have to turn to bearish. It didn't rally, and that's a fact, right? Oops, that's not support. Okay. So while we're below 835, we have to flip to bearish because you can't ignore the fact that we just sat there and then didn't break down or didn't rally. Okay. Stocks are stronger to eventually wait on this thing. But support, next support comes in at the 161% extension of this last move higher, which comes in at 821. Dollar MEX. So we're trying to find support at the wedge support. So I'm going to mark up the lows at 1980 as being support right now. Resistance is at 20. We have to get above 20, which is that trend line resistance right there. Or, you know, we could actually write 2001. We have to stay bearish while we're below that trend line, this trend line. While we're below this trend line, we have to stay bearish. Dollar yen. So the dollar yen, the break below this 80.35, we have to take note of it. But also, here, let's get rid of this for a second. Let me get rid of some of these fibs here for a minute. I need those out of the way. No, they're obstructing our view of other things. Okay, so rallies back to 80.35 or 80. It was 80.35, but we could give it up to 80.40. This will be resistance now. That's key. Resistance for the bears to hold. So the way I'd look at this is the dollar yen is turning lower. So now, if you get any rally back up here, you want to sell, on moves back up towards, the 108.35, 108.40 level. It's going to give you a good risk reward to be on the short side, because if you can get short around, like, let's say 108.40, you don't have to risk much. You could risk maybe up to 108.60, 108.70. So, you're risking maybe 25 or 30 pips to make, I don't know, down to 107.60, maybe down to, 107.60 to 106.75. I mean, so let's just say that you're risking 25 or 30 pips to make 70, maybe 130 pips. That's a good risk reward, and just any way you slice it. So support is 107.66. And with the dollar yen, I'm going to flip it to bearish. And the reason why is because we are below that multi-year trend line break. Okay. So again, I'll explain. You have this trend line. We broke it, got everybody long, squeezed out all the shorts. Everybody got out. Everybody started thinking, okay, we're going to go way up towards 114. Now we've dropped back below support. It got all those people that were long out, and now it's reversing lower and is probably aggravated a whole lot of shorts that were short before and they got squeezed out. So they're going to be looking for reentries for a move lower again. And yields are moving higher. Oh, with yields moving higher, might actually support the yen for now, but we'll see. We'll see. But while we're below 108.35, you've got to remain a bear, in my opinion. Dollar index. So the dollar index, as I pointed out on the FACE webinar, we're at support. Support is at 91 right now. Resistance, though, any move back up towards this trend line. So any move back up to this trend line should be a selling opportunity. So 91.50, but probably more important is 91.70. Okay, 91 is support. 91.70 is resistance. And that's probably pretty key resistance on any rally. All right, let's go over to the S&P. Well, we can do the S&P. So here's the S&P. It's still bullish. I know Bitcoin is starting to move lower, and that is obviously a risk. Support right now, this resistance, this trend line, that comes in around 41, let's call it 41.55. While we're above 41.55, you have to remain bullish. Resistance would be the upper end of this channel, which is at 4,200. So if you guys are long, if it moves up to 4,200, you probably want to be a seller, right? And if it moves down to 41.60, This is a place where you want to be a buyer of stocks. We happen to be in the middle of the channel. There's not a lot to do right at this moment in time because we're in the middle of this channel currently. Okay. Oops. 4,200. Gold and silver. So gold. Oh, wow. We dipped just a little while ago down to basically 17. Well, actually, that was 1766, but 1762 should offer support now. Resistance. And you guys got the update via ForexAnalytix. You know, we were basically right here. It's a couple hours ago. Gold hit a new high, but the rally is with divergent relative strength, which is overbought, which could mean that gold pulls back before a rally. We could come back below the 1775 level soon. So we did that. We came back and we dropped down to 1760, basically 1765. So I'm going to write down 1762. Actually 1760, and while we're above that, it's bullish. 1790 was resistance overnight, but we should make our way towards 1805, I would think, initially. Silver struggled at the 38% retracement, which is interesting. That's at 26 support. Man, you know, I'm still looking at 2380 to 2680, but I'm trying to give you something more intraday, which I think we're range bound here. So I mean, the 618 comes in at 2471. So let's just write that. That's 2626. Bitcoin. So while Bitcoin is below 60K, this is the broken channel, right? So my opinion in Bitcoin is, now that we've broken that channel, is you want to sell rallies back into the channel right here. That comes in at 60K. So we are going from what was bullish last week. Once we broke through support, it's not bullish anymore. Now we're range bound. And if we break through this 50, what is that spike low? 50,500. It turns bearish if we flip through that support. Okay. All right. So there you go, guys. Your bias chart is finished. I think Steve and Stelios are here. Hey, Steve. Hey, Stel.
We are not. Leave a message.
We aren't. Sorry.
Hey, how's it going?
Good,
mate.
Good.
Oh man, I got up this morning. I slept like a baby. Like I got up in the middle of a dream. Like when my alarm went off, I was like, oh, what am I doing awake right now? And so ever since I've been awake, my eyes have been watering like nonstop. So
is it allergy season?
Yeah, between that and I was sleeping like I could have slept at least another hour, for me. But boy, between that and allergy season, whew. Anyway, so we've had a lot of moves overnight. I think the Bitcoin move is really got to get our attention. And I don't know if you were here a little bit earlier. I pulled up the DSI, the Daily Sentiment Index, and this is pretty important. And Greg in our chat room, he pulled this off of the DSI site that when numbers are extreme for a sustained period of time, the moves that we tend to get are aggressive. And that he's like, that came straight from the source. And that was like Friday. My dogs are scraping at my door, so excuse me here in just a second. But you'll notice volatility, for example, is at 9, which is obviously extreme. But it was at 10 on Thursday, 13 on Wednesday. It was, I want to say, was it 13 on Tuesday? No, 10 on Tuesday and 10 on Monday. So all last week it was really extreme. And I've been looking at these DSIs for years now, and I have to agree that we get dips down to excessive extremes or really high to an excessive extreme. And when it's not there for a long period of time, it just, we tend to get a little bit of a pullback. But when you see these sustained moves, we do tend to get bigger reversals. So that's something to think about, especially when you're dealing with volatility. And, equities have been obviously elevated for a long period of time above 85. So he looks at above 85 and below 15, I think is what his numbers are. And, I've always been more concerned with like closer to 90 and closer to 10. But these are some pretty extreme numbers. So I think it's worth noting.
And they've been there for a while. That's the thing, like you said.
Yeah.
Yeah, they have. And so if that happens, that's the, I was saying a little bit earlier, I wouldn't be surprised if this dollar move was like squeeze everybody out, all the dollar longs. You see the cable squeeze above 139. I think we're more range bound than in a lot of these, but you get a lot of dollar longs out of the market, and then the market reverses hard and everybody will rush right back into the dollar. So it's interesting. I think we got to just keep a real close eye on what's going on. I'm going to let you guys take over. My dogs are barking. My dogs are barking. That's an old saying when, people say my feet hurt, my dogs are barking. Here, my dogs are actually scratching and wanting to eat because it's 6:45 and they know it's feeding time for them in the morning. So I'm going to let you guys take over.
Cool. Thank you, Blake.
Thanks, guys. Hey, everybody have a great one, and enjoy your time with Steve and Stelios. And thank you all for your support, as always.
Thanks. Thank you, Blake. So it's a bit of the same. The dollar is creeping lower, and I think we've said this before. As long as equities don't turn and or yields don't shoot up quite a bit, then this will probably continue to grind and grind. And yeah.
Exactly, Stelios. I see no reason for this to change. I mean, fundamentally, there are a billion reasons, right? But, the current market environment is what it is. And in my opinion, going against it is very unhealthy for your trading account.
Yeah,
until we get something,
It's impossible to time this. That's the thing.
Yeah, exactly.
It's been going on for days, weeks, months, years, really, and it's very difficult to time it. So,
yeah, in a sense, since the COVID lows, which is now almost 13 months ago, right?
Yep.
In a few days, it should be 13 months ago. There has not really been any real pullbacks, right? We just had, a few periods of consolidation having to do with risk assets. Pullbacks have been minor. Probably the biggest one was this one, which wasn't anything, to write home about. And it is what it is. I mean, makes sense, doesn't make sense. We like it, we don't like it. Doesn't really matter.
Even on the COVID pullback, the snapback was amazing. Within 3 months, we're back to where we were. And think about the event that we had. I mean, that event was Well, I've never seen anything like it in my
and
life.
still
So,
is,
and still is, yeah.
because some have either already done so or pretending to do so. They're forgetting the unbelievable costs that COVID has already um, accumulated in the system. I mean,
Yep.
huge debt in all economies, so they can fight this off. Massive increase in unemployment. Um, we're clearly seeing inflation, picking up almost everywhere. Um, People might have not realized, but we've had more than 1% inflation during the first quarter of this year. So even if inflation stays at the pace we had in the first quarter, the end of year inflation will be above 4%. Many people haven't realized that, right? And not to even go into the conversation about how skewed inflation metrics are, and how much higher probably inflation is if what we're seeing is that. I mean, without even going in that speculation, just by taking the official numbers into account, we're looking at an end of year inflation of above 4%.
Yep.
Yeah, and this is actually one of the reasons that we've seen the equity indices and risk um, work in correlation with the yields, because this move higher both in yields and risk assets in essence is pointing to what they call, I don't agree with the expression, but I'm going to use the expression, inflationary growth, because inflationary growth is not actually growth. That's why I don't like the word there. You know what I mean? Under an inflationary environment, of course, the nominal prices of things and assets are going up. We've said that before. So let's see how the next few quarters go, but I think that's what the markets are more or less pricing in. Not that it's fair pricing, because as long as they're also pricing in rainbows and unicorns, as we've said before. In any case, as I said in Face webinar before, in my opinion, the biggest technical event of the day is the breakout from cable. We closed on Friday exactly on top of this channel's trendline resistance, and so far today we've been seeing a decisive break higher. I mean, we can have a lot of speculation if this is a false move or whatever, but in order for me to even assume this is a false move, we need to get a reversal lower. Until that happens, since this break is in the direction of the trend that was there since the COVID low, I can't really, in good faith, assume that I shouldn't trust this move. So I'm assuming I should trust this move, as I'm going to be assuming I should trust this move higher once we break above this technical formation, which is an expanding triangle in the case of the euro, and we should be looking for higher prices. As simple as that. Now, I also showed before the breakdown in USD NOK, following with what is it, like 3-4 trading days of delay, the breakout in the prices of crude oil. Now, having to do with precious metals, gold seems to have found resistance to the 38.2% fib of this last move lower. And in the case of silver, the exact same thing, found resistance on the confluence of the 38.2, confluencing with the 50 DMA, with this horizontal support resistance area. So, in both cases, not conclusive technical evidence yet that we found a low. We might have, but the jury is still out, having to do with gold and silver. I can't really say the same about palladium and copper, because palladium broke out from this flag and is on its way higher. Very, very close now to the all-time highs at 28.79. If you remember, I warned once we broke through the symmetrical triangle that palladium is on its way again. And here is copper also. I warned about this, that this is most likely a symmetrical triangle, and these usually break in the direction of the prior trend. The direction of the prior trend was higher. So this also confirms the move from the Aussies side. Aussie in this case was leading by a little bit the move in copper. So there is that. Now platinum seems like gold and silver. Actually, the platinum currently looks more like silver with a delay to me, if you're asking me from a technical perspective. So I'm not still convinced that platinum is done unfolding whatever kind of complex correction it is currently doing. Now, you want to be bullish against 1170. There is a technical basis to be bullish, but I remain more neutral until I get convinced that this correction is over. I'm not doubting or changing my thesis having to do with the medium to long term. I believe platinum has a lot more to go to the upside. Same with gold, same with silver. Nothing has changed in regards to that. I'm just not sure they're done correcting yet. That's all. Natural gas, also some kind of a complex correction, although it has broken out from a double bottom. In this case, we got a double bottom at 245. Keep that in mind. Once we broke through 266, in essence, we've triggered a double bottom that points higher towards that resistance. But I wouldn't be putting my money here. I see better. I think it's going higher eventually as well. I'm also not changing my thesis having to do with that. I'm just not sure we've resumed the upside yet. Another pair that is actually breaking lower, and I forgot to mention before, is USD-SEC. So USD-SEC, clearly a corrective channel higher. We first broke through the RSI trendline support. Today, we're attempting to break through the actual channel itself. That will be a bearish development pointing towards 782, which is this low that we found at the beginning of 2018 next. So we break and close through this channel, and in my opinion, we've confirmed that we've opened the door to a new low, to lower lows, in essence. I think that's more or less. Oh, yeah, I had a couple more things I wanted to talk about. In case any of you were not in FA.C.E, I consider this area to be key for the DXY 9080. I think below that, more or less, we're on our way to new lows towards 88.25 in the DXY, while yields haven't really convinced me that they've turned lower. I mean, they're clearly correcting somewhat here, but that's not exactly the move I would expect out of an ascending wedge. And here's the 30-year as well. I mean, so far the move lower has been extremely orderly, and that means most likely corrective. Keep that in mind. With whatever that implies for USD yen as well. The reaction lower in the case of USD yen was clearly stronger than the actual move in yields, which is kind of peculiar considering that risk is on and yields, yes, have been moving lower. USD yen clearly tracks yields. But as I said, it has exaggerated a little bit the move in yields, which, given the fact that risk is on as well, it looks to me more of a technical correction of the move higher. So far, I can't really complain. It's been following the template I had envisioned almost perfectly. So I wouldn't be surprised to see, lower prices before USD yen can resume to the upside. Just now that we've hit the 38.2 and the 50 DMA, and we see that yields have been stabilizing, I would be somewhat more careful here with more potential downside in the case of USD yen. So I wanted to mention that as well. So more or less that was the recap I had in mind. So I'm going to pass it now to you for any questions or requests, or what you want to have a look at. Stelio, you included, if you have anything in mind.
I think we covered most of the stuff. I mean, yields is something again that is come out of the radar for the moment. After the big jump in 10-year US couple of weeks ago, when was it, 2-3 weeks ago? Now we've kind of we're moving back to 160 and kind of staying around there. So I think we need to be watching yields. Obviously, they're not doing that much last few days.
I think the same thing applies to yields, Stelio, unless we see some real risk off. I find no real reason why yields would really, strongly turn lower. You know what I mean?
Yeah, I agree.
I don't see any real reason why that would be the case. So yeah, I mean, I would be very, very careful. I think yields can continue creeping higher eventually, as long as we don't see a change in the market's mood. And as I said before, the market seems to be pricing in some kind of an inflationary growth, and that would be clearly positive for yields, right? Now, as I've explained before, and bringing the conversation back to the metals, in my opinion, the market is trying to front run a reaction from the side of the central banks against that inflationary growth, and that's why gold and silver remain, in consolidations, because I think the market is scared that central banks will increase rates to fight inflation, and that should be negative for precious metals. I think that's a mistaken assumption. I think that the market will realize that the Fed and the rest of the central banks can't really do anything about it, because the only way they can do something about it, of course, they do have the tools, but use these tools, and they will, in essence, trigger the bomb that lies in the bottom of the pyramid, the Ponzi scheme that has been built upon asset price inflation. So, in my opinion, central banks will act only when it's really, really late, and the market thinks that that's not the case and they're bluffing. I think having to do with this, they're not bluffing. They're really nowhere near reacting to whatever we get. I think that even if we get the measured CPI at 4%, as the first quarter would imply, they would still be doing nothing about it. Although the market seems to disagree with me, I feel quite strongly about this opinion. I believe that people are going to be surprised about how much central banks will be willing to tolerate before they actually do anything about it. So I think that the next leg higher in precious metals will begin once the market realizes what I'm just explaining, that central banks are not bluffing, that they will be extremely patient and will be waiting until they can actually see inflation's white of the eyes before they do something about it. They will keep on claiming that it's all within the context of symmetrical inflation, and since we had lower than 2% inflation for so many years, we can tolerate higher inflation, and that it's transitory, blah 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 blah.
They have a natural bias to avoid tightening.
Of course,
basically.
Of course.
So that's why they're going to leave. Our friend Jason is saying, listening to you and Stel's position on the market, especially the indices, it sounds as if you don't ever expect the market to go down again. Is that your assessment? No.
No.
If that was my assessment, I'd be all in long equities, or I'd have a position. I think we are going to go down. I'm just saying it's very difficult to time it, and the way we're grinding now, there's no sign that something's changing for us to be short or to consider being short. So I do think there's going to be another leg down. What's going to be the trigger? I have no clue. Just like in COVID crash, we didn't know what the trigger was going to be, but I think we're going to get one. But same argument I have for silver and gold, that I think they're going up eventually forever because of inflation. The same applies for stock indices, obviously.
Mm-hmm.
But so I'm not saying, oh, I'm always going to be bearish, or I think I'm bearish now. No, I'm not. But I think we will have a leg lower. But when we do, that's the time to start slowly accumulating. I mean, depending on your time frame, obviously, I'm much of a longer time frame person, but that's where I'm going to start accumulating. My biggest regret was when we had the COVID crash in late March. I started buying, and I got long some equities, individual names, and unfortunately, it was just too little.
Yeah, I did the same thing. I bought and
when we got to 3,000.
Yeah, and I started offloading. I
Yeah.
couldn't really believe that we would push without any hesitation to all-time highs and keep on going, because stupidly I thought that the market at some point will have to realize that, fundamentally speaking, I mean, there are a lot of issues following COVID. But of course, that was a stupid assumption from my behalf, because I should have known better after so many years in the market. The market only cares about, the short term and whatever they throw at it. And currently we have like almost infinite amount of money being thrown at it, and it will keep on focusing there until it has no alternative than to focus on something else. So listen, having to do with my thesis, once you inflate a balloon with helium and you let it go, it will start climbing higher in the sky. Now, at some point, you know that it will reach a height that the atmospheric pressure is going to be so low that it will have to take the opposite direction, right? The problem is, in this case, the balloon is the markets, and it's not easy to know the exact height at which the lighter air of helium is going to equate, the atmospheric pressure, and what's going to happen, or if a bird is going to fly by, poke a hole in the balloon, and then it's going to start going, lower with speed. So what I'm trying to say here is that there will definitely be bumps, and these type of markets have the tendency of being non-stop bid until one day something happens, and then the market is forced to realize how insane valuations are in in comparison to what has just happened, which always brings a scare that perhaps central banks won't be able to contain it, and then you get a massive sell-off like the one we saw in COVID, until central banks can once again start doing what they're doing and calm the markets that don't worry, we're here, we have your back, and then the markets start buying again and we go into this relentless bid. Now, at some point, I believe that there's going to be a massive type of reset once the realization that this cannot go forever happens. But it's impossible to time this. So somebody cannot be trading with the idea that, okay, I have to be prepared and I have to be defensive for that day of reckoning, right? Because that day of reckoning might be in a year from now, might be in 5 years from now, it might be in 10 years from now. It's just that buying here, although I do believe we can continue going higher, fundamentally won't let me sleep well. You know what I mean? And this is not the kind of FOMO trading I want to be doing. I know that I'm missing out frequently, and I know that people that are amateurs can be making more having to do with equities, etc. But I don't really care, because what's more important for me is to be able to sleep at night without waking up and looking at the markets and uh, you know worrying that if something happens overnight, I might wake up and find the markets 10% lower instantly. So, we do believe with Stelios that eventually and long term, the tendency of the markets to keep going higher is going to be there because of inflation. But there is definitely going to be big sell-offs on the way. And at some point, we might have an event like the one we got at the late 80s with Nikkei, meaning we might see the US indices put on a long-term top, and then they might even take years to to find it once again. But anyhow, all those are possible scenarios for the future. For the time being, what remains the case is that we have markets that are extremely buoyant, and contrary than what psychology tells us humans to do, that is not an indication that you should be selling them. It's probably an indication that you shouldn't be trying to fade them, until something, something big happens that can put in at least a short-term top in place.
We have a friend who's saying, when that day of reckoning comes in fiat zero, wouldn't the answer then be crypto? I think fiat currencies are flawed the way they are because of the way the governments and the treasuries, they issue at will, and they basically debase the currencies. All the major currencies, they do that. I think crypto, the theory behind it is amazing. I wish we could have something like crypto, or something which is not inflatable, right, as a currency. That would be ideal, because then you have proper price stability.
I don't want to sound like a broken clock.
Let me just finish what I said, but
Yeah.
I think that would be ideal. The only problem is that the governments will never allow that, because they cannot exist without the ability to print more money, to fund their their unfunded liabilities and their negative cash flow basically every year. That's the problem. Otherwise,
Exactly.
it's a perfect solution, but the governments will never let it. That's
we already have the perfect solution and the perfect money. It's gold. People might not even know that gold has even a natural inflation, which is 1.5%. The supply of gold annually on average increases by 1.5%. So we had the perfect money for thousands of years. The reason central banks and governments abandoned it is exactly because it doesn't allow them to do what they want to do. And it's exactly the same reason why no cryptocurrency has even the faintest chance of replacing fiat money. Now, on another point, unfortunately, there is a second problem. Not only that, if governments wanted to turn back to real money and solid growth and principled economies, they could just go back to gold, which it is the perfect money, as I said. But cryptos have another problem. They're also fiat, meaning, yes, any given cryptocurrency has a specific algorithm set. For example, Bitcoin has a specific supply. What is it? 21 million Bitcoins, if I remember right, something like that. Okay, fine. But on the other hand, it lacks the intrinsic value that gold has. Gold was established itself as money thousands of years ago. Why? Because it was first a commodity. It was a commodity that everybody accepted and wanted, because it's a precious metal that doesn't rust, doesn't go bad in time. As time passes by, it doesn't go bad even if you throw it in the sea, which corrodes everything. So its tangible values remained unchanged over time, and it could be used for doing other stuff. So it retained its attributes as a commodity, right? So cryptocurrencies might not have the unlimited supply that fiat currencies have, but they lack the intrinsic value component. So what happens if any cryptocurrency gets barred? You know what I mean? Or they forbid it from being traded or whatever. What is the alternative use you can have with it? Nothing, because it's backed by nothing. I would be all for a cryptocurrency that's backed by real assets, be it gold, be it silver, be it land, I don't know, be it any kind of resource that is of value and has demand, actual demand for use. So yeah, I don't see really how cryptos can take over.
Yeah, we've said this so many times. Governments is going to be the main obstacle.
Of
The
course.
governments will want to take advantage of them, and they can't because they're anonymous, they're peer-to-peer, they just can't control them, theoretically.
Oh,
So
of course. I mean,
anyway,
just look at Yellen. She came out like a few days ago. What was it, last week or the week before that? And in essence, she pleaded for other governments to agree in some common acceptable minimum tax so US citizens don't have so much of an incentive to take their money and leave to avoid upcoming higher taxes in the US. So part of this is the fact that they cannot give monetary authority to an individual agency or crypto or whatever, because through monetary policy, they also want to control taxation, right? And you've seen how strict all the rules, supposedly the anti-money AML, anti-money laundering, all that is BS. Money laundering is a very, very, very small part of activity. What they've baptized as anti-money laundering policies and KYC, know your customer, the vast majority of them are not to avoid terrorist funding and and money laundering and all that. It's actually to make sure that they can tax as much of the income being generated as possible, because they desperately need the money.
cool.
Some cryptos do have utility. You're using BTC to smear all. Listen, even if that's the case, the market and not myself has decided to crown Bitcoin as the cryptocurrency of cryptocurrencies. So I have every reason to mainly talk about Bitcoin because it's like, what, 70% of the market capitalization of all cryptocurrencies. And we're talking about 6,000 of them now, right? So when you have one of them having like 60, 70% of the capitalization of all of them, then as long as the market has decided that this one is so much more important than any other, then I have every reason to focus on it as well, myself, having to do with criticism. Now, once the market, and if the market ever decides to replace Bitcoin as the dominant cryptocurrency with one cryptocurrency that actually has utility, as you mentioned, then we can have this conversation again. But we can have it both ways, meaning we can have Bitcoin being acclaimed as the master of all cryptocurrencies, and at the same time, me having to focus my criticism on a cryptocurrency that might have, let's say, 2% of the market capitalization of cryptos, right?
Anyway, it's a long conversation, and there are pros, cons, and arguments on both sides for sure.
By the way, we're seeing some type of a reaction lower in the markets. Of course, it's like, let me bring on the 4-hour chart.
Generational low inequities. Come on.
Yeah. There it is. There it is. Here it is. Stelio, there's your chance.
Tiny little red candle.
Yeah, in the 4-hour chart. So it's, it's probably generational low, as you said. Anyhow, I'm here in the 4-hour chart. I'm monitoring this ascending channel, as you see, which we're currently testing. I mean, at some point we have to have like a small pullback. I mean, we've seen several small pullbacks. We haven't seen one since end of March. It's almost a single month that we haven't seen even the tiniest pullback, right? We had like a horizontal consolidation here, a horizontal consolidation here, and it's non-stop higher. So at some point, I'm assuming that this market will have to put some kind of a minimum, pullback, even if it wants to resume higher. Now with probably like the strongest area of support being closer to 4,000, right? 4,000 is also psychological level. So let's watch what happens with the markets today, since it's the S&P is attempting to break through this channel. Although, as I said, I think that it's we get a corrective move here, it's more likely to be something minor than anything else. Not unless we get some news. RSI divergence is ongoing also since You know, what is it now? Like 15 days ago almost. So, you know, worth noting. Any other questions? Okay.
Cool.
Nasdaq coming down. Yes, as long as the S&P. Let's have a look at the Nasdaq as well on the 4-hour chart. Here it is. You can clearly see that, you know, momentum was clearly, you know, waning here on the way up. We did manage to produce a higher high though, because I remind you that the Nasdaq was seriously diverging for a period of time with the S&P. We seem to be somewhat heavy. You can clearly see here the RSI divergence as well. So let's see, we might have some type of a pullback here, but you know, don't keep your hopes, you know, really high and your expectations really high. I'm the first one that hopes for some kind of, you know, volatility increase. I mean, God knows the market really needs, you know, some kind of a, you know, tune change. Here's the VIX also having gapped higher on the day. Let's see, it would need to cross over like 18 and a half before we can, you know, seriously talk about it. And clearly, you know, the DXY will see some kind of a rebound if we get some type of a sell-off. But as I said, it's still early on the day. You know, let's see how the day unfolds. For the time being, you know, we're seeing dollar weakness, which isn't really surprising. It's just a resumption of the theme that we had the previous week and the week before that. Okay, let's see.
Steve.
Let's hope we have more to talk about tomorrow. Bye, Stel. Bye, everybody.
Thanks, everybody. Thank you.